Futures slightly lower with stocks coming off their biggest one-day gains since May. Joining us now, Ed Yardeni, Yardeni Research president. Ed, it's good to have you on this August Monday following Jackson Hole. I know you've written a lot about it. Do you agree with Powell's new tone that tariffs' inflationary impact will be short-lived? It'll be temporary?
Well, I think that what the tariffs have done has kind of kept the inflation rate from getting down to 2%. Inflation now seems to be stuck more like around 3%. And he may very well be right. And I think a lot of people expect that the tariff effect will be sort of a one-shot deal. The problem is the tariffs are not a one-shot deal. For example, the administration is considering tariffs on furniture right now. So it could be a one-shot deal that lasts several months. But in addition to that, the services inflation rates are still fairly hot. And so if you've got durable goods inflation going up because of tariffs and the services inflation rate still running relatively hot, the Fed's not at its 2% target. It's at 3%.
So do you think it would be misguided then to cut 25 basis points in September?
I think so, not only because of the credibility on the inflation front that the Fed needs to maintain, but also because I think the economy is actually still resilient. I know that's a very controversial and contrary point right now, especially after the payroll employment report for July showed piddling increases in May and June, and then a 73,000 increase, which again is relatively low, but it is an increase. And I think we're going to see an increase in the August number at the beginning of next month of 100,000, which I think is closer to the sort of the break-even employment rate that we need in order to keep the unemployment rate down at 4%. So, yeah, I think there's no particular rush to lower rates, but that's exactly what's changed in Powell's speech. For many months since the beginning of the year, Powell's been saying we are in no rush to lower interest rates. And what got the market so excited about the possibility of a Fed put is that he didn't say we're in no rush. He just said, it may be time to make some adjustment here. So that's where the Fed is. The Fed won't listen to me, of course. They'll do what they're going to do. But there are a couple of inflation indicators, and there's a payroll employment report that may change their mind.
But the bond market itself doesn't seem to be too concerned, at least in terms of its reaction on Friday to the potential pivot. What do you make of kind of the bond vigilantes right now and their concern about the Fed's ability to fight inflation if it does pop back up again?
Well, for all the excitement in the stock market about the Fed put making a comeback in September, the bond yield is still pretty much tracking in a flat range. 4.29% is last I saw. Well, I guess you have it on your screen. It's 4.27%. But that really isn't much of a change in the face of expectations that the Fed is back on an easing course. And I would say that the cautious tale is what happened last year when the Fed lowered by 100 basis points and the bond yield went up 100 basis points. In this case, if the Fed goes ahead and lowers rates, we may find, we may all get frustrated, including the administration, that the bond yield is still kind of stuck around here and the mortgage rate's still staying around here as well.
Either way, Ed, you remain pretty constructive U.S. equities. Yes. It's funny to see the reaction on Friday to the potential of a cut, and it was one day, but a big jump. So will it affect your view either way, if they cut or not? Well,
in either case, it's a bull market. The question is whether it's a bull market that has a melt-up phase. It kind of feels like a melt-up already based on what we've seen recently, especially on Friday. The forward PE on the S&P 500 is 22, which is right up there. The Buffett ratio, which is basically the price over the sales ratio of the S&P 500, is at an all-time record high. So valuations aren't cheap, but earnings have been great. First and second quarter earnings beat expectations significantly. And so I think we're going to have a continuation of the bull market, but I think it's going to be earnings-led. If the Fed does go ahead and lower rates on September 17th, I think my targets may be too conservative. Right now I'm looking for 6,600 on the S&P 500 by the end of the year and 7,500 next year. We could get to those targets a lot sooner if the Fed does in fact deliver the all-powerful Fed put.
Ed, how balanced, if you will, when you put those targets together, how balanced are they? Meaning, how much of that is the Mag 7 effectively levitating the rest of the market versus, looking at small caps or other parts of these indexes?
Well, I think what was exciting about Friday is that we finally saw some pickup in the SMID caps, the small and mid cap stocks. The problem with getting excited about that is we've been seeing that for a few years. We've all been waiting for the market to broaden out, and as you point out, it's been still very concentrated. 30% of the market cap of the S&P 500 is in fact still in the Magnificent Seven. So I would say, 6,600, 7,500 next year. I'm still thinking that the Magnificent Seven account for 30% of the S&P 500, and that there'll be some broadening out of the market, but they clearly are the leaders.